Good morning, everyone. I'm Rich Carlson, head of DBRS Morningstar's North American Commercial Mortgage Surveillance and Operational Risk teams. And I want to welcome you to the latest in the DBRS Morningstar webinar series, Trends in Commercial Mortgage Servicing. Today, I have our North American CMBS Operational Risk team with me. I have Michael Merriam and Tom Merck. And we will be discussing trends in commercial mortgage servicing. We're going to start off by talking, giving an overview of our servicer ranking process and program. Then we will talk a little bit about some trends we're seeing in general with servicers and as far as governance goes. And then finally, we will go through some slides that show what we have gathered from servicers from our semi-annual data files that we collect from all of our ranked servicers. So maybe we can get started with the second slide in the deck, which talks about the overall operational risk assessment program. And I think, Tom, maybe you can kick us off with this.
Yeah, sure. Thanks, Rich. I guess, firstly, we ask, why are we doing this? Why are we looking at operational risk, servicers and operational risk? And it's because we believe that the servicers are integral to the transaction's success, and also that servicing quality is vitally important. A vitally important consideration in these financial transactions. So, while it might be tedious for some of you, we tend to dig down into the weeds and look for some of the details that maybe might not come up in some other reviews. What our operational risk analysis are based on, we have site meetings with the servicers. We ask the servicers on a semi-annual basis to supply us with a database with performance records and updated staffing, details like that. We asked them for a host of other supplemental supporting materials. For example, their policies and procedures manual are key, and we review those quite thoroughly and try to determine whether or not they're sufficient and up to date, and also are being followed by the employees. We also concern ourselves with many of the sample reports they supply us with, and also importantly, whatever audits are made available to us. We analyze a servicer's capabilities and performance relative to the types of portfolios that they service. So transactional requirements and its particular role as a primary master or special servicer, we're trying to focus on what are the key elements of each of those types of servicing. Importantly, though, we're not entirely CMBS oriented. We have a holistic assessment process based on the entire servicing portfolio, whether they be balance sheet loans and other third-party investors from life insurers, GSEs, and private CRE funds, for example. ORA scope, you'll see on the comment there that it includes staffing depth, experience, so on and so forth. I think it's helpful to that we break it down into two main categories. In general, they all concern non-credit risks associated with a servicer's role and performance. And we try to break it down into several categories, one being operational infrastructure. And under that gamut, we look at organizational structure, staffing experience, turnover, training, the servicer's plan for growth, corporate insurance adequacy, existence of material lawsuits that may impede servicing ops, audits, compliance, and procedural completeness, and also technology and disaster recovery efforts. Another area we focus on is portfolio administration, where we examine loan administration areas such as new loan setup, payment processing, tax, insurance, UCC admin, investor reporting and accounting. In particular, in this section, we're concerning ourselves with the controls surrounding advancing, and also portfolio management, collateral, credit performance monitoring, surveillance practices, watch list management, handling of credit requests, and subservicer oversight. Importantly, though, we are not, this is not a forensic accounting examination or an internal audit. So we're basing our review of the companies on the materials that are provided to us from the servicer. Bear with me a second. Assessment purpose. Point 3, assess the score servicers across a range of qualitative and quantitative factors. We try to conduct an in-depth analysis that takes a critical look and examines the servicer's operational capabilities and processes for all of its required duties across all functional areas. So that leads us to a focus mainly in 3 areas. The extent of control practices, degree of operating efficiency, and overall track record and experience and performance results. We provide, importantly, we provide rankings as opposed to ratings on the transactions themselves. The big distinction, and our ranking scale leads from a top score of Morningstar Operational Risk, MOR, CS1, Commercial Servicing 1 as the highest score. In general, we're thinking in that area that represents exceeding prudent loan servicing standards in key areas of risk. A CS2, indicating proficiency in key areas of risk. CS3, compliance with key areas of risk. And 4, lack of compliance with one or more key areas of risk. Also, CS3 is deemed to comply with what we view as the minimum prudent servicing standards and requirements for servicers' operational risk categories and roles. We attempt, and in most cases succeed in seeing everyone on a 12 to 18 month cycle and updating our reports and opinions based on that. We also do interim actions, and in circumstances where it's required, we'll place some ratings under review based on current events occurring at the servicer level. I guess importantly, let me point out that asterisk at the end. We do concern ourselves to an extent with financial condition, but rankings are not, these are rankings and not credit ratings, and are not a proxy for creditworthiness.
Yeah, no, that's an important distinction. Thanks, Tom. Yeah, one of the things I wanted to point out too is that the current methodology that we have that published in October was really a merging of the best practices that came from each of the legacy Morningstar credit ratings and DBRS from their historical methodologies. So I think they were surprisingly similar in the areas that were covered, and they both used a four, the historical ones both used a 4-level scale. So I think it was pretty easy to map everything together and come up with, best practice. And so I think what we have now is even stronger than what either of the legacy rating agencies had. So really proud of the work that has been put in for this. So that's something I wanted to point out. Before we go into some of the stats and interesting things that we've found from the data file collection, I thought maybe we could talk a little bit about servicer governance. One of the things in the DBRS Morningstar ESG platform that we are adopting is looking at servicer governance for certain things like data integrity, safety, policies, compliance, things like that. So I don't know, maybe Michael, do you want to start talking a little bit about that and what we're seeing from servicers?
Okay. Yeah, I guess before we jump, I'll put one little point in about the servicer review process, which is we're also part of the CMBS team. So, and we're getting feedback from the CMBS surveillance team in our process. That's been really helpful to get positive, negative feedback, and anything comes related to servicers and how they're reporting. So it's been good with the synergies in the team.
Good point. Yeah, I think that it's helpful that both of the two surveillance and operational risk report through the same reporting line, because I think they're definitely interrelated. Right. So yeah, that's a good point.
Yeah, just jumping over though. Yeah, so as far as governance goes, it's very, when you say governance and servicing, it's broad because it's not just, it's the organizational structure and reporting lines. But I think for purposes of this discussion, we're kind of zeroing in on areas like compliance, audit, vendor, how they're overseeing vendors, data management. Those have all come into, I think, bigger focus of late. So we're seeing servicers really expand their compliance function. I guess if you're talking about a servicer having 3 lines of defense, we see that often talked about being the business line procedures, how they're tracking and reporting within the business line, that regimen. And the 3rd line, if I've got it right, would be like the internal audit function, independent, completely of directly in the servicing. It's sort of in the middle part, the compliance function, where it's in the servicing part, but it's independent, and they're there sort of coordinating audits. They're there to check on, the integrity of policies and procedures. They may be involved in training. And it's compliance from really both the borrower and the investor side. Really ensuring borrowers are adhering to their loan documents, any of the requirements that they have to fulfill relating to covenants, providing financials if they have a consent request, giving all the right requirements. And then it's on the reporting side. So we're seeing that more, and we're seeing the compliance team conducting their own audits. If some servicers have been doing this for a while, it's more common. Doing their own audits or reviews, tracking timeliness, accuracy, looking for that. And they may use things like a risk level matrix, you know, color code it, green, yellow, red, whatever helps work. And you could see compliance involvement in a lot of aspects of the servicing process, right from loan boarding with that. Some things of late, even related to that, would be servicers talking about beefing up their cash controls, fraud prevention, OFAC, Office of Foreign Assets Control. Servicers talking about that more in their compliance area, checking on their borrowers, if we've got loan assumptions going on, things like that, doing public searches on their borrowers. When Tom was talking about our coverage of servicers, everything we look at, investor reporting, remitting is tied in with this too, because we're looking for any kind of errors, recalculations, lateness, and looking if anything's material with the servicers with that, and saying anything we need to know about that. We're really seeing them servicers with compliance too working. It ties in with technology too, because they're enhancing their workflow tools. We've seen progression in their technology to try to get all the compliance elements into their technology tools, as far as trying to automate, tracking covenants, triggers, all the consent request process flow approvals. With that, a lot of more hard programming of PSA requirements. I think we're going to start to see maybe more of that. It's been evolving with seeing alerts, instructions given out to an asset manager, things you have to think about when you have a task to perform. How does this affect the investor? What's in the PSA that you need to know about? Things like that. Governance, as I said, also beyond that is audit. So we're as Tom talked about the audit program, we're seeing servicers usually going beyond Regulation AB attestations. We're seeing more servicers do SOC reports, servicer organization controls, which are fairly comprehensive, and those are designed to assess the operating risks in the organizations. If the controls are in place, they're effective, and then going into a type 2 of a SOC, just to testing those procedures and see if they're how they're playing out over a period of time. Vendor oversight, we're really we're spending more time on that. We're getting actually more information from the servicers on that too. They're giving more scrutiny to all their vendors. It's data integrity oriented, but it's a little bit beyond that too. And I think for all their larger the larger vendors, and if they are doing tech, providing a tech service, they're vetting the vendors a lot more. So we're seeing servicers set up questionnaires, risk ratings, scorecarding. It's going to be more commonplace. And even if the vendors are large enough and they have their own audits or SOC reports, the servicer is trying to get those to review. The process too, if you're a special servicer and you've handled enough REO properties, then property management audits, we'll see those come into play more too as a best practice. So, a lot of it with governance, I think does, as I mentioned, it ties in with technology. So we are seeing servicers go out more to, I think, getting cloud computing, really commonplace. We're going away from a traditional self-managing their data center and all their networks, and whether it's Microsoft Azure, not to drop names, but something like that. We're seeing that more common among the servicers, and it seems to have benefits for business continuity, working remotely, obviously in the last year. So we're seeing that more common with the servicers. And then data security protocols as it relates to governance too. Servicers focusing more, we're asking them about it. How do you do your own data security testing? So what kind of staff training goes on? How are you, checking for intrusions into your system, and so forth. And a lot of the servicers are getting cybersecurity insurance. Haven't heard of them filing any claims yet, fortunately. But when we ask about insurance, a lot of them are saying that they do have a policy covers that aspect with it.
Yeah.
I would just other say with governance too, in how they're trying to be more effective. Borrower web portals we're seeing them come into play a lot more in the last year or more. Certain servicers were able to leverage the portals, I think helping with the relief requests that came through. Borrowers asking for forbearance or other kind of relief, managing that through their web portals and helping sort of like, I think it was complementary to whatever other means they had for communicating with the borrowers. So we're seeing them invest more in that, across the board in technology to make it more of a self-service for borrowers. I saw one servicer lately even trying to put loan performance data dashboards into the borrower portal to get a little more of the view from the servicer of how they view the loan performing based on what the borrower's been submitting with that. One final point, I guess, with this is it's technology again too. Robotics, optical character recognition, things like that. That's been progressing over the last few years with servicers, as far as trying to automate, a lot of the high volume activities relating to operating statements, rent rolls, and so they can spend more time analyzing it. And some of the servicers have gone pretty far with it so far. And I think the key with it was getting their accuracy rates up so they could, know to trust that the data's been transferred from the borrower's statements onto their system and being able to normalize it. So ties in a little bit even with the borrower portal too, because some of that will come through the borrower portal. Documents, things like financial statements, rent rolls, other documents, and then you can sort of deploy your robotic process from that point, grabbing the file and downloading it.
Michael, I think too, it's important to note that we're seeing in a couple of instances where their actual, the servicers are applying mobile apps. So you can actually, go to an app store, download and your app and retrieve a lot of portfolio information through that mechanism.
Right, making it mobile device friendly. Maybe seeing that a little bit more too. So.
All right. Well,
so that's it's interrelated stuff between technology and other areas of their operations. In terms of, controls, efficiency with it. So governance is a wide net.
For sure. Yeah, we had a question come in that I wanted to answer before we go on through the rest of the slides. And the question was, how many servicers do we cover? So it's kind of a two-part answer. We have rankings. When we initiated the rankings, there were 14 companies that we issued rankings for under the new methodology, and that could be a variety. Some of those servicers could have primary, master, and special servicer rankings. However, we do use the methodology to as a framework for how we look at primary masters and specials that are in our rated books. So while we might not have public rankings on the whole universe of North American CMBS servicers, we do see them mostly and perform evaluations and periodic reviews. So just wanted to point that out.
Yeah, right. Probably even.
All right. Go ahead.
More probably on the ranking level, it's probably more than double that as far as the rankings that we have. So.
Oh, right. Yeah. As far as individual, 14 companies, probably 27, 28 rankings. So
something like that, close to 30. Yeah.
30 maybe. Yeah.
Yeah.
All right, well, if we could move along to slide 3 and we can start talking a little bit about the data file collection and the information that we have seen from the servicers. So the first one is talking about total portfolio volumes. Michael?
Yeah, so just to preface this, in the data that we collect, we pulled from the 4 master servicers. Since the really, I think the best or, representation, a really good representation of the industry, since, most loans in rated transactions and more than that are passing through the master servicers. Either they're servicing it fully and doing the full master servicing as well, primary and master, or they have sub-servicers. So that's what we used for that, and to look for some trends with that. So that's what is all behind all these slides that we took a look at in terms of analyzing some of the data. So I guess just to start off of how, if you look at the master servicers trend on the dollar volume of what they've been servicing, the UPBs certainly been increasing, went back several years, and there's a nice progression of their portfolio growth by UPB. A little bit up and down on loan balance, on number of loans, and I think even there was growth in the past year by UPB, despite the pandemic, and they even had a bit of a drop off in loan boarding. Their peak loan boarding going back a few years looked like last year, very high. So the loan count went down a little bit, so what they're servicing, the average loan size was going up. So it just gives you a snapshot there.
Yeah, I thought it was interesting, Michael, that to your point, it looks like while the GSE number of loans increased in a similar rate as the UPB, but to your point, the CMBS traditional number of loans has decreased, while the UPB is roughly the same, right? So it just shows that there's larger loans, right? There's more SASB transactions coming to market. There are those larger loans that get broken up as pari passu pieces and conduits. So I think it's sort of interesting that the growth with GSE loans is really numbers, it's increasing, whereas the growth in UPB is staying about the same, but it's just larger loans in CMBS. It's sort of an interesting fact, I thought.
Yeah, exactly. Yeah. So, this seems to match, because I was noticing some MBA reports of late, and it seems to match with it. Debt outstanding went up, but it went at a slower rate than it did in 2019. Origination volume was up in 2020, recently reported, but lower than 2019. So, so it was increasing, but at a slower rate, which is understandable from the past year.
Sure.
So,
you want to move on to slide 4 then?
Yeah, I think, I mean, slide 4, what that does is, I just kind of blew it up bigger here, just if you want to see the trend here, to sort of the big drivers behind the portfolio volume of the master servicers. And they are servicing a lot of, there is a variety of investor types, no doubt, with what they service. But GSE has been really the engine, Fannie, Freddie, FHA to some extent. This just isolated Fannie and Freddie, and you see the trend there over the years. UPB and even both on loan count moving higher. CMBS year to year was going down, and it's kind of leveled off, and now we're seeing an uptick. So with issuance, so I think it matches. And issuance, I guess, looks like it's on track to be better this year than last year. So it's kind of matching up with that. But no, GSEs have been a big driver with all their different programs. If you're a GSE servicer, they actually said they had a good year. I mean, 2020 from a portfolio and growth standpoint, they were getting a lot of transactions. One just we're reviewing and had a 25% increase in UPB. And loan count as well. Not with that. So So I think we'll see CMBS. Looks like maybe CMBS is coming back up here with that. So,
All right.
yeah. So
if we can move on to slide 5.
Yeah. So just a little bit here on just the property types, and I guess not surprising, the core is multifamily for the masters, and goes out to all the sub-servicers. The big driver there, been dominant. Loan count dropped a little bit on it, but it's still there. Office and retail, then followed by lodging. The retail exposure looks like it's declined as a servicing component of servicing, but it's still significant. Something here at the back end, at the back far right here, you see SF rental. So that's something you wouldn't have seen a few years ago. That stayed, pretty level. See if that starts to go higher. So that's sort of an asset type you would not have seen with it. So.
Yeah, and it's interesting, if we would have even gone further back with these servicing by property types, I have a feeling that some of these large servicers wouldn't have had as much multifamily. I think they had back, after the last downturn, more of a focus on diversifying their portfolio so that they weren't strictly CMBS. And so, I think some of the agency lenders were purchased by PNC, or so I think it's interesting though. I was not realizing how, when you put it into this kind of a format, to see how dominant the multifamily product is within the 4 major masters. I thought that was interesting.
Right. Yeah. I think there's a very small part of like co-ops are in there too, for what they have. But,
right.
And so that was, you would have probably, I know my multifamily years ago, well, it was a little bit different mix in what was affected in the financial crisis. Multifamily, I believe, was a lot more affected than in what we've got going on now. So, I could go back more than that. So, right.
Yeah, and then it's interesting too with the retail still being a pretty big part, but declining. And I think that's because, over the last several years, there's been less CMBS appetite for retail. So it makes sense to me that while there's still, one of the major property types, it's decreasing. Whereas I think, office is staying the same. And probably taking some of the retail that we used to see in CMBS.
Right. Yeah, we'll see some of these later data slices from other angles where some of these property types show up a little differently.
Yeah. So maybe we can move on to slide 6 then.
Okay. Yeah. So we've all been talking so much over the past year about borrower relief and forbearances. They've, so certainly have had to manage a high volume of relief requests, especially in the early months of the pandemic. We were getting updates weekly, Rich, right? We were getting requests, on how they were handling it all, how they were triaging everything, and then what was really transferring or not transferring to a special servicer. So I would say, I think servicers, this has been said in other sessions, industry sessions, but I think the servicers and the specials responded quite well. I think there has been a good sense of coordination, cooperation with the servicers and the special servicers, and trying to figure out, what can you do with the situation? How can you accommodate something with it or not? So as far as forbearances go, and what this shows a little bit is, the GSEs, if you look at it by loan count, they were dominant there with it. And overall, though, forbearances within the master's portfolio, though, really came out to like not more than 1%, what you want to count as in forbearance. So But you've got a big concentration of GSE in the forbearance, and it has to do with their programs that were laid out for that.
Yeah, and I don't know, while 1% seems like it might be small, you have to kind of put it in context that this really wasn't a tool that was used prior to this pandemic, right? Like,
right.
You didn't see forbearance hardly, ever. So it's a huge increase, as far as, another tool in the toolbox that, the special servicers and the masters can use to keep the loans performing.
Right. Yeah, I think that's, and what this doesn't show too is, all the other types of relief that were done, either as not transfers or as transfers. The big one was trying to tap the reserves.
For sure.
For doing that. Forbearance is really case by case. If you ask any of the servicers, how did you handle it? It's all case by case assessment, factoring, right? They got to factor property type, location, how the borrower had been performing, where it was prior to the pandemic, as far as performance goes.
Michael, I think what was interesting too about the forbearance activity that we've seen was the actual processing of them. And some of the services were able to pull resources from other areas and clear the backlog, which was a big help because they were overwhelmed at some point.
Right. Yeah, in the early weeks, for sure. And then it eased up a little bit. I think a lot of these too were rescinded. We were hearing reports of servicers, looking for something, and then either maybe the borrower was able to get a PPP loan, or realized if they pushed if it was going to go to special servicing, realizing that what that was going to entail. So
speaking of which, what a great transition to our next slide, right?
Yeah.
If we could move on to slide 7, it's the summary of transfers to special servicing.
Oh, there you go. Okay. Well, we broke it up into half years so we can get a little bit better of a picture, and went back a ways. This is what the masters in their portfolio were transferring to special servicing. So, whoever was the appointed special servicer. So there's your, shock from the pandemic in the first part of 2020, and then still a good transfer volume in the second half compared to where it had been from the 17, 18, and 19 years, but it pulled back a little bit.
Yeah, and that's sort of interesting. Yeah, the one thing I wanted to point out, and you kind of hit it there, is even though it decreased in the second half of 2020, if you were looking at it as a full year, it still would have been the third largest transfer, right? And this was only in 6 months. If you add the two halves for 2020 together, you're at 56 billion compared to a little over 25 billion that was the largest in 2013. So it just shows the ridiculous amount of transfers that were processed in CMBS in 2020.
Yeah, exactly. Yeah, I mean, right. Yeah, the first 2 years on this chart are full years, and then it broke out. So you've got 2,000 loans that transferred, but a lot of them, don't have a number on that, but they transferred back. They went in, and a lot of them didn't stay too long, and were able to move back with it. I guess we'll see too, as far as what happens with forbearances as they start to expire, where they can get back. They go into the payment plans, or any of the other short-term modifications start to burn off, or keeping an eye on reserves. If you're going to start depleting reserves, then what? So whether there's going to, and I think some special servicers, they're kind of gearing up. They're prepared for still more flow in with the loans into special.
For sure. So moving from transfers to special to the special servicing balance. Let's move on to slide 8.
Yeah. So, I mean, it really shows the spike again from year-end 2019 to year-end 2020 with CMBS was a good portion of what was in special too. More loans, a lot of this, I think, if you look, you can't even see it well on the chart, but there's a third bar here, which is GSE. It's low. it's in the legend here on the chart, but when I first made the chart, I wasn't sure if it came. Where is it? But that ties in the fact that a lot of the GSE loans didn't, to try to do something for the borrower that made sense. They didn't do it as a transfer event, so they were able to try to work with the borrower on the primary master side of it. So that's the function of what the GSEs laid out, and also contrary to that, also what you had to do in terms of honoring servicing agreements, or what was in the PSAs as far as what your requirements would be to manage something with it, and depending what year the loan was too, whether it was a CMBS early 2.0 or later 2.0, differences like that. But it's still less than during the great financial crisis.
Yeah, and I think, the one thing to point out here is, it's amazing how low the amount of loans in special servicing were in 2019. And I think that was helpful. It was kind of a double-edged sword, right? Though it was helpful because there was capacity to take on more assets, but special servicers may have also adjusted their staffing levels in 2019 or as they were working things out, because you don't need the full complement of asset managers. But historically, and we've all seen this, the special servicers are really good at finding people to come back to, checking their LinkedIn, basically their Rolodex of people, and letting them come, getting them to come back and work for them. Right. Not something that we're really worried about even at this point with all these transfers.
Yeah, that's one thing went, through our minds is, they were reducing their staff over 2018 and 2019, which, staffing, fluctuates with volume on a special servicing side, or being able to redeploy to other areas and, due diligence, or, buying B pieces, whatever. But right. Their portfolios were dropping. So I guess they were fortunate in that their portfolios were at a lower point going into the pandemic, and they were then able to bring people back in. And so it was probably, if the pandemic had happened in an earlier point, when their volumes were also very high, it could be a different situation.
Right.
So we had that. The industry at least had that going for it, where it was. So so that just lays it out in a picture here of how the volumes of where it's been in special.
Right. Yep. And then when we move on to slide 9, it shows it by property type, which I think is interesting as well.
Retail and lodging dominating at year end, and on a percent basis, retail looks greater by UPB. Lodging was greater by loan count a little bit, but if you look at it within property type by count, you've got a higher percentage of lodging than retail, and lodging is what really. If you look at that bottom chart we slipped in there, core property types from end of 2019 to end of 2020. Lodging moved way up. So retail moved up from we saw the numbers, from what was in master service portfolios, it doubled on account. But retail maybe wasn't going to be able to go up as high because it was already high.
Right. Yeah, I think, to your point, retail was already experiencing some stress because of changes in shopping behaviors and tenant bankruptcies and things like that. But yeah, lodging, which had been performing really well, just, was slammed. It basically, with all of the restrictions of the pandemic, they were just hit the hardest. But, historically, lodging also is the one that comes back the quickest. So it'll be interesting to see what happens as travel restrictions are lessened and businesses maybe start going back to some sort of business travel, to see what happens with lodging will be very interesting. Right.
Yeah. So let's, I think there's a different dynamic between those two types of properties. In a lot of respects. So in terms of, their position, which can come back more. So,
all right. And then anything else or
I was just gonna, let's see. Well, I was just gonna, things we know what's playing into loans and special servicing, and whether they can sort of how they're going to come out of it, how the specials are going to be reducing this activity, and what the progress has been. Evictions and foreclosure moratoriums are still in play here, so you've got that stretching out, probably some timelines. I think, Rich, you talked about it being a delay of game.
Yeah, that was, yeah. So, I think with the moratoriums on foreclosures and evictions and things like that, it's been a slower process for some of the loans that have been in special servicing. And it kind of is shown, if we can move on to slide 10, that it's talking about REO volume. I'll let Michael talk here and it's interesting.
Well, we were looking at the loans in special servicing, and then I realized, wait a minute, I shouldn't just be looking at loans. I've got to look at what portion of these serviced portfolios are REO. So we had some information on that, and it's been moving lower because a lot of this was, pre-pandemic. Retail was a high component. The special servicers had been doing, good job reducing their REO portfolios over the last couple of years. So you see that in the chart. As far as, the property type concentrations changing of what's year to year, what's the composition. So REO's taken on a larger piece of it, even though they've been able to liquidate a lot of it. So, and then, maybe also declining still, this is only through December, but because we just mentioned the moratoriums, maybe that'll come more into play now into this year, but, to the extent that it's been repressing REO volume.
Yeah, and I think that's right. I think, in surveillance, we're seeing more of the loan status codes being in foreclosure. One of the things that I think is interesting here too is that, there was a reduction in, even in a pandemic commercial real estate market, there was still a reduction in the amount of REO from December 2019 to December 2020. Mm-hmm. And while it doesn't look like it's, it's still a lot lower, because obviously from year end 18 to 19, there were more foreclosures that would add to the REO volume, as opposed to, in 2020, there weren't that many that were processed. So, it's still a small amount, but you were still able to dispose of some of the REO assets in 2020, which I think is interesting. One of the other things here too is to point out how low the lodging REO count is, and I think partially that's because of the challenges of owning and operating business. And I think there's some other things in play too, with some of, from what we're hearing, and with servicers, some of the franchise, the flags like Marriott and others are requiring guarantees from the servicer that PIPs will be in place and things like that, that I think are are pausing the decision as to whether or not you want to become, you want to take the loan REO. So it'll be interesting to see as travel comes back, what happens with those, and you can kind of find out the ones that are going to be impaired long-term that weren't just because of the pandemic.
Right. For what it's worth, I have an insider at a discount retailer, and they can't keep luggage in stock.
Yeah. Well, that's a good sign. Yeah, that sounds good, right?
Yeah.
All right. One of the things we were also wanting to highlight was servicing, master servicer advances. So if we could move on to slide 11. And Michael, whatever your thoughts are here.
Well, the picture says a lot here, but had data able to go back to 2011. So we saw that's the financial crisis, the tail end of the financial crisis through 2011, 2013, through that period. And but just jumping over to where we are now, it's not where it was. So, but it's moved up over the last year. As far as outstanding balances, although the number of loans dropped in the second half. So, maybe that's some easing to what, was moved over into special servicing. But it's high relative to the past few years, but it's still within manageable amounts, given what the master servicers had, advanced years back.
Yeah, I mean, when you're looking at year-end 2020, it's less than a third of, I think probably year-end or sometime in 2012 was probably the peak of the advancing. So, we're still at less than a third of the amount of advancing that is outstanding. So I think part of that is a little bit that there's more awareness of advancing, given, all the experience from the last downturn. And I also think that there's probably some better appraisal reduction provisions in newer transactions that might keep some of the advancing at a lower level, which is good for everybody.
Right, yeah. There was one servicer noted recently during a conversation I had, they're advancing more on retail loans than on lodging. I mean, they're still advancing on lodging, but the retail had overtaken it.
Yeah.
So, still.
Yeah, I think because to your point, you had mentioned earlier about being able to use reserves to make payments. I think that was more prevalent within the lodging loans because of their business being shut down and being able to use what should have been replacement reserves or PIP money to pay your mortgage. So
yeah.
All right, and then we have one more. Oh, sorry.
Yep.
Did you? Okay. We have one more slide that's talking about staffing. So if we could move down to slide number 12.
Yeah. So just to tie it together, as far as where, again, this is just looking at the master servicers as a kind of a representation. Look, total servicing employees, it looks like it's fairly stable. And because it's master servicers, this chart, it breaks it out for total employees and then what they have US and offshore. You've got two of the master servicers have sizable offshore platforms, all in-house, all employees, part of the servicing teams, but they're based offshore. And so you have that going in play with this. But just as far as capacity and workload levels, it stayed fairly level over the last few years. It even dipped down all in, combined loans per employee over the past year. And so it's all kind of stayed in that between 40 and 50 over the last few years, 42 loans per person right now. And it's an imperfect calculation, but it gives you some sense. So, I think the servicers are servicing large and complex loans, more and more. I mean, that's keeping the ratio down despite all the automation advances they're trying to, put in place. There wasn't a lot of, big hiring over the last year for the servicers, as some of their portfolios, they didn't board as many loans, so they could redeploy perhaps some staff related to that. But you see loan count had gone down. As we noted earlier, loan count went down in terms of the overall. So, that's kind of just where it helped, with their loans per employee. They actually had a little overall, master servicers had as a group, they had a bit of a reduction in staff. One had a net increase, and that was really the master servicer that had a loan count increase. Yeah. So maybe there's a tie-in between loan count and staffing, more of a correlation. Multifamily GSE servicers, though, have added staff. Not to overgeneralize it, but the ones we've come in contact with, they've been adding staff because their portfolios been, especially they're growing because they're GSE and they're being fueled by the Fannie and the Freddie Mac issuance.
Yeah, that's a good point. And then I really like your just to have a little bit on special servicers. While we don't get the data file from the whole special servicer universe, just the assets per asset manager, I find interesting. I don't know if you want to talk about that.
Yeah, I mean, as we mentioned, so the special servicers, the portfolios, they were at a relatively low point going into the pandemic. And so, they were reducing and reassigning people over the past couple of years. And they rapidly staffed up. We got some interim numbers into the first quarter of 2020. And it was actually amazing to see how much they, brought people back on. So some were able to do it even with not much external hiring. But it's a little bit more of a different story on the special servicers and the masters. The specials had to staff up, and they staffed up quite a bit and in a short period of time because the pandemic happened so rapidly. So what we just noted here, just taking a look at the special servicers that we review, assets per asset manager, it's moved higher, it seems, but it still seems reasonable. And the ratios are better from what I can remember from 10, 12 years ago.
For sure.
I think special servicers, it didn't, maybe the fact that the assets came in so fast this time and not knowing how long the assets might be there and what the outcomes, what are your options? What are the outcomes going to be? What tools are you going to have, during this time of a pandemic to resolve these loans? They acted quickly, and there's, so if you're an asset manager, you've got good employment prospects.
All right. Well, we are almost out of time. You get the three of us talking about servicers, and we could probably go even twice as long as we did. But I don't know, Tom or Michael, anything else you want to add?
Just this, that we scratched the surface on some of this. So if anybody has questions, please don't hesitate to reach out to us.
Yeah, that's good. And also, I think that the business development team will be able to share the slides and, of course, the methodology if anybody wanted it. So, all right. Well, thanks, guys. I think this was a good discussion. And thank you, everybody, for joining us. And we'll see you next time.